The US is a great spot to be, but I look at places like India where the growth rate's probably 2 to 3 times what we are. Great story. I think Japan's now kind of on a little bit of revival as well. There's some places I think, Germany that you could own besides just the US. Give yourself some diversification. At the same point, lower some risk and some valuations overseas may not be as pricey as they are here. Typically, we're going to like ETFs simply because of the ability to own some things that are on the local markets that you can't necessarily buy yourself. So India is a good example. There's not many US traded US traded individual stocks, but there's 4 or 5 ETFs that we're aware of. We probably own 3 of them that give you exposure both to the large cap and the small cap, the more domestic oriented scenarios. So I think that dovetails very well with giving you exposure to a market that is a big booming market, big capitalist market, but doesn't have a lot of individual stock exposure. There are a handful, but I think the ETFs are a better way to play it. I think Germany, I could make the argument that you could own some individual stocks there, but the ETF's not a bad way as well to own and get some diversification. Japan, I think, is an interesting story. There are some ETFs out there that allow you to short the yen or short a foreign currency and be able to be long the stocks. We favor those. We think that the dollar continues to be stronger against some of these weaker foreign currencies. I think that gives you the double play of being able to say, I can own the companies, but I also can be short the currencies. And I think that's a good way to be able, again, to add some diversification. Most investors are going to be long US dollar, but they're not going to have anything denominated overseas. So it's good to have something that's short yen or short euro or whatever it would be to give you some diversification away from simply looking at US only stocks and US only currencies.